Hello and welcome to our webinar event, More Than eSignature, Capturing the Full Value of Digital Transformation, presented by eOriginal and featuring Forrester. eOriginal is the leading digital platform for financial services. From signature to vaulting to transfer to the secondary market, we enable the creation of a fully digital financial services ecosystem. I'd like to take just a moment and introduce today's presenters. Today we have with us Mr. Steve Bisbee. Steve currently serves as the president of eOriginal, and he is also the founder of the company and a co-inventor of eOriginal technologies. He oversaw the creation of unique eOriginal solutions, enabling the efficiencies of fully digital commerce, and continues to lead the growth for eOriginal. Also with us today is Mr. Craig Le Clair, our featured speaker. Craig is the VP and Principal Analyst at Forrester. He is one of the stronger voices for covering digital transformation, concentrating in the eSignature space. Thank you both for being with us today. And with that, I'm going to pass the presentation over to Craig.
Some are really poor and some are good. But look at the width of that line. That's the range of companies in terms of their scores. So quite a bit. Some are doing it better than others. So you can be either on the left of that or you could be on the right of that. So that's what we're really talking about. To get there, digital transformation is important. So this is the 5 steps that we think companies are really pursuing that are doing it. We talk to thousands of companies. We synthesize what they're doing and try to synthesize that and push it out in terms of five steps in this case, all the way from holistic experiences to fueling innovation. And this is really if you look at it step by step, is all about how do I become a more digital business so that I can interact with an ever digital customer so that customer experience is achieved at a much higher level. So part of that is how you just view processes and services and experiences that you're providing. Sort of the old way on the left, is sort of an inside-out view. It's about the core system, the legacy system, how that views and records transactions in your organization. It's about products and services. You're likely to be digital prey if that's your perspective. To be a digital predator, to be able to take market share away based on digital technologies, you need to have this customer-focused view. We call it an outside-in view. You have to look at more than just the products and services. You have to look at experiences. What is the customer sensing and feeling and thinking while they're experiencing your product or service? It has to be outcome focused, outcome in terms of the ultimate outcome for the customer, not the outcome of a specific silo within an organization. Such as the warehouse fulfillment system. Did that meet its metric of getting the product out the door? Well, that's only one aspect that is a piece of the aggregate experience that the customer's seeing. They want to see that they're properly billed, as well as getting the product from the warehouse, as well as having the order placed enjoyably. So you have to look at whether the desires, satisfied outcomes, and experiences. That's just a different view of processes. The way leading companies are looking at those, so that's the way you look at it. So if you look at it, then what do? Well, here's a methodology called customer journey mapping that's probably very familiar to many of you on the phone on this session. But it's a progression from methodologies we've used to redesign processes going back 30 years, 30, 40 years, where they tended to be more focused on that inside-out view. Let's take a look at the swim lanes and the systems analysis and design for the invoice processing area. Right? It wasn't looking. The customer was very secondary. So customer journey mapping is now the methodology in fashion. You see the journey there on the left, discovering, evaluating, buying, using, getting support. These are this one view of the customer journey. So the analytics as to where the customer is, the context of the customer, to understand that seamless transition. A simple way to think about this: if you're doing customer journey mapping for someone getting on an airplane, you would start with the alarm clock going off and getting out of bed, getting into the shower, getting in the taxi, going to the airport, and this is all part of that experience there, of course. And then they get dragged off the airplane at the end of it. But you're thinking about three things during each of those touch points. You're thinking about what are they thinking, what are they doing, and what are they feeling. You're getting to the sentiment of them as they transition. So this is a whole sort of newer area of methodology for redesigning processes. This is another, aspect of transforming digitally, is to take advantage of these new technologies. The Internet of Things, basically using, the brilliance of having IP addressable entities all over the place, that have the ability to give you information and location on where things are, to be able to communicate with them in a smart home, smart vehicle, smart kitchen. Basically, that's a really big transitional movement. The Jetsons, if you can go back that far, we're projecting 100 years out from when they created that series in the early 60s. And at that point, if you think about what the Jetsons had, they had robots, which we have now cleaning the house. They had robots serving them, and they had flat screens everywhere, and they had a lot of it right, but they didn't actually get the Internet of Things aspect. They weren't the vehicles floating around in space weren't communicating with them, and so forth. So it was actually only were in some ways more advanced than when the Jetsons looked at in the early 60s. So that's really important. And this is really a critical slide, in the sense that if you want to get to the kind of agility you need to fight off digital disruption, to fight off those digital predators that are going to be coming after you with new business models, native digital, native cloud-based services, those are coming at you. And you have to be a much more responsive organization, which means you have to flatten out the organization. You have to use internal collaboration tools, which many of the leaders in transformation are doing. You have to use collaboration tools that are going across and outside of your firewalls, either with a Facebook Messenger or a WhatsApp or a Slack grid, to really get your customers interacting with you in totally different ways. So this is sort of the new emerging information and communication-based set of communities that companies are going to need with their supply chain and with their customers. So moving along here, it's replacing silos with dynamic teams, as we just talked about. And most of all, it's leveraging and incubating emerging technologies. So that's kind of the high-level aspects. I'm going to pivot now to more actionable technologies that are important for transforming digitally. And this is a very simple slide. It really is just saying there's a customer experience part of the problem, and there's an operational excellence part of the problem. You can think front office in the top and back office in the back. And you need, for that transformed customer experience, you really need to have both working in harmony. You can't just have a great mobile app that's connected to a legacy environment that doesn't really allow the right operational excellence. So you have to look at them kind of in harmony in a more of a straight-through way. There's almost more and too much conversation around that customer experience and mobility and social and big data and all of that to try to get a handle on the customer. But if you can't deliver the product off the shelf, if you can't build them properly, if you can't do these operational things, then your experience is not going to be there. So I'm going to drill down into the operational technologies here, and it puts eSignature in the context of that. What you have here are 3 lines. This is a bit of a complicated chart. This is our approach to not getting robotized over time, is to have really complicated charts that will take the robots a while to be able to understand. So if you look at these different phases, these are different sets of technology. Think of them as technology markets that can be applied to help get rid of analog and paper processes, and hence to become more digitally operational. So you have things like enterprise content management, be basic taking paper and making electronic folders. You have electronic forms you see. You have the various workflow derivatives, business process management and dynamic case management that are doing process orchestration. You have kind of emerging areas like robotic process automation that allows you to build scripts to emulate human behavior at a desktop. That's a way to get rid of the robotic aspects of a human and take them out of the human and put them into a robotic script or a bot and free that human up to have a stronger customer experience. Looking at where eSignature is, so that's a good line to be on, that blue one, because eSignature is having strong value to the business. Once you can secure that transaction without a wet signature, you eliminate a lot of the paper. And it's also showing a relatively early phase in that we're still adopting to it. There are still legal framework issues. There are still technology issues. As we'll see in a few minutes, there's changing and emerging of technologies there. So that's why it's in kind of that earlier phase. It hasn't gotten to the maturity of many of the other technologies that are on here. But just putting it in perspective, I group it in terms of a set of building blocks that are really needed to move a company to a digital business. Now, the trends in eSignature, customer-facing processes is a hot area. Onboarding new customers is really, really important. That can be a global bank. It can be, a retail customer. It can be a property and casualty insurance company. These are the ones that are investing in getting rid of the paper for wet signature. Consumer, small business, mortgages, and commercial loans are a very, very hot area. Customers and employees basically expect to be digital. One company I was talking to is a big hotel chain, and they said, you know what, I'm trying to recruit and hire people all the time. If I have to tell them that we're going to go down and to the office and do FedExing and UPSing of overnight packages, that makes me look like an old company. I want to look like a new company, a modern company. Customers don't want to have to maybe drive into the office to sign documents the way they used to. If they're dealing with an insurance agent, they're happy to go in once to talk about the deal, but they really don't want to go in and waste the gas to sign it. So there's a strong push, particularly with mobility. Some 30% of all agreements are at least viewed on mobile before they're executed. So already we're seeing a tremendous movement of eSignature toward the mobile world. The digital mortgage market shows digitization progress. It's been not a fast one to move. We know it's had its challenges, both from an execution standpoint, the 2008 area financial crisis, but also in the compliance area, which is related to that. So it's not the fastest moving area, but then there are substantive and important agreements. So there's been a slow movement, but we're starting to see some progress, some digital progress there. And Europe is had some, really interesting regulations. I mentioned here EIDAS. The EIDAS, terrible acronym, but it basically means that every country in Europe needs to accept and honor an electronic signature of a certain standard, of a certain quality from another country. So Italy cannot no longer reject a signature executed in France as being legally binding. That's been a real boon. And they have in Europe a different infrastructure. They have more emphasis on trusted service providers that are issue digital certificates against physical vetting of an individual. So, in that case, they might have a personal visit or a video or a phone call and do a personal vetting and provide a digital certificate, which is then used as the authentication element for a signature process. So that's very different than in the U.S., where we basically use various forms of authentication, biometric, frequently asked questions, internal credentials, and so forth, maybe an SMS two-factor authentication. We use a number of approaches to get to authentication, but don't really require a digital certificate. So very, very different, markets there, very different approaches. But basically, if you look at the eSignature market now. So I'm not talking about transactions in the sense of an eOriginal doing a transaction that involves vaulting and securitization, but really just the platform you might use to absorb a document, put it into a server, provide the eSignature wrappage around it, be able to trap the electronic evidence, and be able to archive it. The eSignature basic capability has been commoditizing. There have been a lot of providers coming into the market. The pricing has been declining, so it's approaching $1. It's probably less than that. For some, you have some providers that are less than that. A lot of the providers in that market, seeing that commoditization, have repositioned their capability to be a digital transformation platform. So they're adding things like forms management, they're adding workflow, they're adding customer communications or doc generation capability. So being able to provide more than just a signature is a trend we're seeing in the core e-signature market. This is just to give you a sense of the use cases that dominate. As I mentioned, the business to customer, which is the B2C. The bottom one is the area of the most interest right now, the most activity, the most investment, account opening, sales team, integration with Salesforce or some other CRM solution, independent agents. The business to business would be like a non-disclosure agreement, as you see there in the lower right of the middle. That's a very commonly executed agreement between companies. Why not do it digitally? For business to enterprise, that's internal. Things like quality assurance sign-offs, very, very important in manufacturing and process manufacturing in particular, in the, say, pharmaceutical industry. Non-compete letters, the things that many employees don't sign when you're dealing with the losing of the physical paper. Now you can have you can have bots that actually ensure that an employee has signed the non-compete level, and when you do it digitally, you have a much better tracking mechanism to do that. So those are kind of the use cases. The market as a whole for e-signature has been growing at a very, very healthy clip, 50% plus a year in terms of number of transactions settled digitally. Now, this is not your transaction at the drugstore, where you scribble something on a signature pad and you're signed. These are substantive transactions, where a potential conflict could occur down the road. So, but basically, we're seeing strong 50% plus growth in the numbers. Now, this is an important slide. As I talked about, you have eSignature, platform, and these started to really evolve particularly in the U.S. as a SaaS market 4 or 5 years ago. It's moving, as I said, to a commodity status for the signature, and so there's more emphasis on a broader digitalization approach by those platforms. So the signature becomes a component of the digital platforms. You see in the second from the left there, and then you have e-transaction management, which is really looking at the end-to-end business transactions. So eOriginal is going to talk about that in a minute. Negotiable instruments, secondary markets, lots of regulation. That characterizes e-transaction management. But I want to talk a little bit about an area that is getting a lot of attention these days. Forrester has a number of analysts working just in this area, is blockchain or distributed ledger innovation. So I'll just have a few slides on that just to kind of get us grounded, because when you look at this area, there's no way you can not talk about that potential of that distributed ledger for handling transactions in a very different way. Is it revolutionary? Yes. But is it being overhyped? Completely. And there's lots of confusion. How it really works, what are the appropriate use cases, the gap between we're seeing a lot of POCs and prototypes, a lot of messaging from providers, and really large-scale deployments. And blockchain really stemmed from cryptocurrency, from Bitcoin. And as you know, there's 21 million Bitcoins in circulation right now. They're worth $1,500, $1,800 depending on the day. They're used a lot for currency transfers, person to person, business to business, that are that don't involve any traditional financial institution. And this is sort of the point, in a way, of blockchain, is that it bypasses your traditional banks, your traditional insurance companies, your traditional everything. And it's an open source data store, database that has no central governance. In that way, it's very analogous to the Internet. The Internet was designed, as many of you who study the history of the Internet know, it was designed by the Defense Department, the U.S. Defense Department, under contract with some companies that designed it for them, but to withstand having whole sections of the network blown away so that the network could reconfigure itself. So there was no initial central authority for either from a technology standpoint, and think of maintaining the routing tables for the network. There was none of that. It was all a distributed database application that had the intelligence in every individual node in the network, and that was the key to its success. That was the key to its growth, and it grew without any formal body being involved. And blockchain is very similar to that, and that's why it's gaining a lot of legitimate excitement. So when you look at it, there are implications, though, for how does it interface to existing systems? What about security and risk management? Does it depend upon Chinese programmers working on servers in the APAC region? There's a lot of vetting to be done about it. And the technology has been endorsed and taken by leading companies like Accenture and IBM and others to try to provide that level of security around it. But it's still very, very early in the days. So we think it today is, it's really, adoption is not imminent. We're seeing some projects transition from POC, but not nearly enough. Right now it's in this sort of just beyond the phase of irrational exuberance. The main point I want to leave you with is that it's not one thing. Blockchain is a set of capabilities that are in this sort of shared ledger database concept. So there's a smart contract execution module, there's auditability module, there's a identification and authentication. These are the areas that immediately start to affect the e-signature and e-transactions market, because you have auditability and you have identity and authentication. You have some things there that, many of these things here are already done in, say, eOriginal's, solution for the financial services industry. But these are components that you can either select individually or in aggregate to do for a particular use case. So, it's not like it's an app that's developed. It's more like it has microservices that can be deployed for a particular purpose. Now, in summary, and I want to turn it over to Steve here and give him some time because I'm probably near the end of mine. But, in summary, tomorrow's transactions require more than basic e-signature. And further, digital transformation requires these 5 essential elements that involve cultural and technology change. And then it needs the operational technologies that I talked about. E-signature is a strong component of that. So with that, I'm going to turn it over to Steve.
Good afternoon. So thank you for joining us today. I want to continue the conversation that Craig has had with you about how you capture the full value of digital finance transformation in particular. So from eOriginal's perspective, and it's very similar to Craig's, is that we view the digital disruption as occurring in different waves and stages. And when you look at the moving of digital business processes to disruption, it begins with e-signatures. Though there have been many digital processes around the signature, it is the capture of the digital signature that's the initial point of engagement or commitment of the participants to a digital business transaction. It's the visible participation, it creates enforceability, and as Craig said, we're now seeing some very broad acceptance. But then, what is really then the next step? Well, we talk about digital transaction management, or DTM, for those who are short on acronyms. It starts with e-signature, but it continues throughout the post-signature management. And as you mentioned, the move towards digital transactions and then fully digital business processes, where you have both the processes and workflows that are also becoming digital. As Craig mentioned, some of the traditional e-signature providers are moving into this space. The global e-signature leader, DocuSign, who's one of our partners, is also leading the transition and expanding of the utilization of digital transaction management environments. And we're working with them directly, especially in financial services. But what we see is once you get a number of these processes in place, which we'll talk about in a moment, how do you merge these into integrated ecosystems where the transaction participants really can collaborate. And we'll talk about non-sequential collaboration in digital interconnected networks. So what is driving this digital transformation? What creates a need for these digital ecosystems? So here are just some examples that we see in the market. If you look in the top center, disruptive financial alternatives. Well, this has been a big driver in our world. Marketplace lending is, of course, a big part of it. And the marketplace lenders are really origination engines, but they have created very simple, consumer-friendly, low-cost originations, very innovative, and they're quick. And so you see people, companies like Lending Club, Marlette, Prosper, SoFi, and others in the marketplace lending, but you also see other digital finance companies like Goldman Sachs, Marcus, Consumer Bank, and others that have come into the market, which are requiring the transactions be digital from their commencement to their completion. And then if you go to the right, you see compliance. So we're seeing this is an external force. Compliance, whether it be from the CFPB, OCC, FCC, or others, they do not want to wait until a transaction is complete to review these transactions in paper or with images. They want to see trusted data, they want ease of access digitally, and they want to either real-time or near real-time reporting. And that's only going to be available in a digital world. So the financial institutions are looking at how they can provide this access and information for compliance in a digital format. As Craig mentioned, one of the specialties or the emphasis for eOriginal is enabling securitization. So securitization is when you take the digital assets out into a secondary market in a pool or portfolio. And this provides anyone involved in digital lending access to lower cost of capital, and you need less capital, especially if you do it quickly within a digital environment. And you want to be able to execute quickly across multiple parties. And if you are if you're a marketplace lender, well, you don't have paper processes you can't drop back to, so you have to be able to execute in a digital environment. And that has actually been a central force for moving into digital securitization. We'll talk a little bit more about that later. Okay? And down below, risk management. Risk management is an internal force. What we're seeing actually directly here at eOriginal, but also with our customers and partners, is that the corporate governance is requiring really established best practices for risk. This wasn't really present as much prior to 2012, 2013, and it's also applying to vendors. And this is driven by the board of directors and shareholders who are saying our company needs to know what happened, by whom, when, and what was the result at any time. And so this can only be done by providing a full chain of digital custody, which is, again, a driver for digital finance. One of the things that Craig also alluded to is that trading partners are increasingly discriminating against non-digital players. We are seeing people that just won't play with those who don't have a digital capability. One of our customers is a small mid-ticket lease company, and once they found the benefits of being digital, especially in their ROI and their ability to capture market share, they turned to their customers and said, you have to interact with us digitally, and then their investors digitally, and then their custodians and their warehouse lines digitally. And it's made them actually very, very successful. When we look at mobile and social, people talk about this being millennial, but it's just not true. All of us are totally intolerant of time. And now that we have these devices that provide us immediacy in both our business and personal and consumer relationships, we want it to be done simply, and we want it to be done now. And so there's every number of our customers that actually measure these seconds can cost you the loss of engagement, not just with the consumer, but with business players. You have to be able to execute as quickly as possible. And that what's considered possible, of course, is different from the consumer side than from the business side, but it's created this need for speed. So when Craig was talking about essential elements and the 5 essential elements, 2 of them are enabling business agility, you see this to the left, and connecting silos. He noted that there's a need for moving from these traditional siloed functions, and this is especially true in financial services. Financial services is a sequential environment. A has to happen before B can happen. And so you'll see that to have a fully connected digital business process, there's a list of various. It isn't just the signature, it isn't just the asset. There's the customer resources, the APIs, the compliance systems, API workflow connectivity. All of these things have to be integrated, or ability to be integrated, or ability to provide information among the systems in order to be able to have digital transaction financial ecosystems. And as Craig mentioned, we're also now seeing additional tools and processes that could be added to this, including blockchain and open ledger. We'll talk about that in a minute, but also verification and analytics in particular. eOriginal is developing a process called datalytics, which we'll talk about a little bit to make sure that we're also able to capture the information and data required for analytics. And eventually we'll move to artificial intelligence and machine learning. We're not really seeing that much in the financial services side yet. So as a result of this, eOriginal is developed into a trusted digital finance platform over the last decade, enabling secure, compliant, and efficient digital management across many different types of financial transactions life cycles. And what am I talking about when I say the life cycle? For most people, when they consider a financial transaction, it's from a consumer perspective, meaning I'm entering into an agreement with some form of finance company or lender in order to obtain money to purchase X. It could be a car, could be a house, could be a television, could be whatever it may be. And so in the financial services world, that application and underwriting side of that is referred to as origination. The e-vaulting side of it is once you have the origination and the execution, then how is that managed? How is that beginning of the digital transaction management, and what is that environment? In the eOriginal world, we refer to that as e-vaulting. And then once these assets, it could be the mortgage note, could be the car loan, could be an alarm contract, could be any type of consumer loan, how are these actually created into pools that can be managed and reviewed by investors, taken by the originators and moved out to the investors? And then once the investor is committed, how can you get them out into collateralization, collateralization being where these assets are pledged for capital, or securitized where they're going out into the secondary market under some very strict rules. Then you have to be able to verify and validate that the digital assets you have are what they're represented, and to make sure that the secondary market investors and the services that they employ and the custodians that they employ all have the same access to both the information and the data. And how do you integrate these silos? Well, here's an example of digital loan transaction management, and just makes it a little easier. And of course, this is not comprehensive, but just wanted to show you have the customer acquisition, and that's generally what we see, and that's what we think about when we talk about marketplace lending or digital lending. Is how do you acquire that customer, get through that origination process, provide the documents, get the documents authenticated, get the people authenticated, get the documents executed, the disclosures and consents which are required, especially in the consumer world, and then how you move it into the originator vault. And you'll notice in here there's this tamper sealing, which is basically done with PKI digital certificates, the integrity check, which enables you to check whether the seals have been broken and if there's any way that document is not an electronic original, providing digital access rights, very deep rights and responsibilities, privileges, and the audit trail. And this is what Craig was referring to, that these are things that people look at for blockchain, which are already built into the PKI infrastructure of eOriginal and other platforms. And then you see going out into securitization, collateralization, being able to maintain authoritative copy, which is an electronic original version of the instrument, and how you get out into custody, into the custodians. So this is really just to give you some flow of what we see in terms of financial services for digital transaction management. But what's very important is you see this as being very sequential. And to really create the business agility that Craig's talking about and create the interconnectivity, we have to be able to move a little bit beyond the sequential, and also that we're becoming much more data-centric than document-centric. Investors are not looking to take possession or control of documents necessarily themselves. They want to know that they own them. But what they're really interested in is the data. It's what's being represented around those assets and how those are managed, and making sure they have a trusted data source as where we're going in the digital financial management industry. So what are the benefits of digital securitization? Well, here are some of them. One, it quickly provides you access to data analysis. You're able to monitor and run reports in real time, either on an individual document or an individual transaction or a portfolio, and get asset level data. In the digital world, you're able to capture and record all of your transaction data, ensuring that the collection of the data and the analysis is available from all the integrated electronic document sources throughout its life cycle. So it's an aggregation capability, which is really, really important, especially if you're on the end of this investment chain. you have the audit trail. Craig talked about having the audit trail around the execution of the signature itself, but you also need the audit trail around the transaction. You want access to all the actions that are captured and be able to provide who did what to when on different aspects of all the documents within that transaction. And then you have to have the ability to have the auditor support. And this is both internal and external. As I said, there's the compliance side, which is external, and internal, which is the risk management side, but you need to be able to respond to auditors via a digital solution that integrates the audit analysis as well as providing a reporting tool for existing data sets within your own financial institution. And what's become very important is making sure you have transparency and compliance. A year or so ago in the marketplace lending world, there were a couple of blips in terms of trust, and that really brought a number of the marketplace lenders focusing on making sure that there's transparency. It's a consumer transparency, meaning the consumer knows what their documents are executing and why and when, and they have the ability to follow that transaction and get copies and availability of the data around their transaction, but also providing that real-time data access across the various types of documents and the entire transaction for the investors. To show the true chain of the loan execution all the way out through the custodians. With this true transparency, you're going to be able to get out in the secondary markets and, of course, achieve a lower cost of capital. As I mentioned, one example is an automotive finance company where they fund the dealer the same day, and they're able to move their assets into the secondary market either the same day or the next day because of this digital ecosystem, which we'll show you actually an image of in a few moments. Here's an example. So with our partner DocuSign and their eSignature solution and our post-signing transaction management, one of the major marketplace lenders is SoFi. And we are both privileged to be able to serve SoFi. They really use innovative technologies to support non-traditional underwriting and really offer a unique set of solutions, specifically leveraging securitization to increase their capital and borrowing power. So by integrating the DocuSign's eSignature tool with our eAsset management platform, SoFi begins with electronic signature functionality and maintains that throughout the life cycle of its digital transaction in a fully digital environment. So in the long life of a loan agreement, they can use that digital asset management processes and systems to provide transparency to the parties of the loan agreement as well as the investors, and the investors can move forward with certainty and confidence in the securitization process. And what's interesting, SoFi began 2014, 2015 to move into the securitization market, and since that time they have executed approximately 20 securitization of student and consumer loans since, I guess, December of 2013 for a total value of approximately $28 billion. And they were the first fintech company to receive a AAA rating from DBRS and an AA2 rating from Moody's for their notes. And so what we're seeing is the acceptance of digital assets out in the secondary market. All 7 rating agencies have accepted assets managed in the eOriginal system, and we have over 35 of the major securitization issuers council opinions, which have also been able to be supported by eOriginal. This slide really just talks about some of the ecosystems. We see that there's been an ecosystem that's been developing around the lender side and the funder side. And these are not all the companies. These are just representative. These are not all customers or partners of eOriginal. These are just some of the different players that are in the different stages of these transactions, going from the borrowers and supporting the borrowers, the lenders, getting the contracts executed from doc prep and the origination systems, how you manage the assets, how you do risk mismanagement and data verification, becoming a very, very important aspect in terms of getting out into the digital secondary market, and of course getting the custodians and the trustees on board. If you're not going to be able to deliver these assets to a custodian or a trustee in a digital format, then you're going to be very hesitant to move forward with the beginning of a digital transaction. And then we have leaders there like Millennium Trust and US Bank and First Associates that have helped enable that process. And so just So we talked about this being a need for a non-sequential process. So there's a strategic opportunity or next step in leveraging the ecosystems by providing a non-sequential, collaborative, real-time ecosystem environment. Craig has discussed this concept in other contexts of digital workflows. But as I mentioned, financial transactions are sequential. You have to get to origination before you get to underwriting before you get to closing before you get to delivery to the investor before you get out in the secondary market, to the custodian, warehouse, and so forth. But with technology platforms such as eOriginal, where you have known participants, you can enable actions to be taken as soon as possible or needed, and it can be done out of sequence in a digital world. And we have examples of that in the securitization, where there are selections of the participants, the rules of engagement and delivery are set, and they're able to programmatically execute the digital transactions that are part of the securitization, being able to move from a process that takes sometimes a couple of months to do to a week or less, a week or more, a couple of weeks. The legal infrastructure is there, and it really creates value in terms of best utilization of the people and resources, and you're not waiting for other parties. You're able to execute these intelligent processes by providing different alerts and notices at a very granular level digitally that lowers the friction of the interaction in these transactions. So eOriginal provides this digital financial platform, and one of the things that it allows is the organizations to interact, manage, and transfer the assets on their own. I mean, we're just a technology platform, but it gives them the independent ability to create their own digital relationships. We recently just sort of discovered the impact of this. So since in late 2014, the image on the left really illustrates some of the way our vaults connected to other vaults around October of 2014. And this is just a portion of the markets that we serve. And we can see that there are a few connected vaults, but really not many. Most people were originating and managing their assets in the vault and keeping them there. We saw some transfer of electronic assets from one vault to another, originator to seller for collateralization and so forth. But the difference is when you look on the right, you'll see there's a growth of our customers and participants, and most importantly, their investors that really are developing networked connections. It really has created a shift as to how eOriginal is being used. An investor now can aggregate securitizations, interact with the banks, the finance companies, the marketplace lenders, the investors, warehouse lines, trustees, custodians, originators, their insurers, their auditors, their compliance, are all able to work in these ecosystems based on their utilization of the platform. So we have over 600 of these in this particular version. 600 folks who have different vaults. There's over 350 companies that can be interconnected. There's almost 2,500 individual administrative users that are able to set up the processes for the interactions among themselves digitally, depending on what their role and choices of interactions may be. We have 25 plus more of the largest banks and investors, including Goldman Sachs and others. And the important thing is this is absolutely not static. One of the things we discovered, this has been growing on its own, sort of independent of the involvement of eOriginal. When you look at the sort of the center right, you see there's looks like a Death Star. Well, it's not. It's actually a very successful auto finance ecosystem that did not exist a year ago. It's been created by the participants. It enables real-time transactions, both from the consumer origination, to warehouse lines, being able to move out to investor markets, filing regulatory compliance, dealing with their internal and external auditors, and the speed in which they've been able to do this has really created a much dramatic market share increase for them and actually greater corporate value. And as I mentioned, they are able to do same-day funding, but also getting out to the secondary market within the next day or so. So this really sort of exemplifies the value of having end-to-end digital transaction management through the use of the eOriginal platform, but it also illustrates the value of having an interconnected ecosystem or ecosystems where the technology can enable multiple players, depending on their role and capacity, to work together in a 100% digital format from origination out into the secondary market in real time. And it includes all the very aspects, whether it be simply reporting, monitoring, as well as dealing with the assets themselves. So what we're seeing is there's going to be a need, and this is the success of this utilization we're seeing is going to create a need to build and connect with one another, utilizing digital finance platforms in ecosystem framework. Hopefully moving to non-sequential, more so than today, but the main thing is being able to execute the need for speed, the need for certainty in terms of the transactions, security, data availability, and being able to move these transactions throughout their life cycles. Thank you very much.
Craig and Steve, thank you both for two very informative presentations. And to our audience, we've now reached our Q&A portion of the event. So if you do have any questions, please use your chat window and let us know if we can answer anything for you. All right, I do have one that came in, and this is directed to Steve. What are the challenges facing the convergence of marketplace lenders and traditional lenders, and how will each need to adapt?
Thank you. So we've been talking about marketplace lenders as if they're really different than traditional lenders, and a year and a half, 2 years ago, that was so. And we really thought that there would be a lot of friction between the utilization of marketplace lending technology and traditional lenders, but we're really seeing a convergence. In fact, one of our advisory council members, John Barlow, back in 2015 highlighted that there was going to be this convergence of both into digital lending. And the reason is that the marketplace lenders have really the ability to create these low-cost originations at a much lesser cost and speed, higher speed than a traditional lender. And the traditional lenders have a large customer base, depositor base, compliance, and access to funds. So we are seeing, in some instances, we have a marketplace lender which has recently purchased a bank. We have I mentioned earlier about Marcus, where Goldman Sachs is creating a digital bank. We see a number of the larger, even the largest of the traditional banks developing offerings very similar to marketplace lenders. And as the marketplace lenders move into the world of secondary market, they're going to have look a little bit more like traditional banks. There was an article in the Wall Street Journal yesterday on Monday which talks about the online lenders regaining market share, and they mentioned that marketplace lenders are adjusting to be a little more Wall Street than less Silicon Valley, and that one of these is the ability to securitize their loans, which is, they refer to as selling them out in packages rather than as a third party. And so I don't see it as so much as confrontational. I think we're going to see that there will be some point solutions that will be purchased by larger lenders. There'll be some of the larger marketplace lenders that will take on and begin to look like or buy institutions that or organizations that look like traditional lenders for the purposes of compliance. There's the ability to get a national bank charter, a specific type of national bank charter that could be made available to online lenders. But when you look at the requirements for that really the requirements make you look very much like a traditional bank. So I think there's going to be not so much the friction, but there's going to be this convergence where in 2 years from now we won't be talking about marketplace lenders or traditional lenders. We'll only be talking about digital lending.
The next question that came in is for around the DMCA, Digital Millennial Commerce Act, signed by President Clinton in 2000. There's been less than 5% reduction in paper since then. So what do you see are the barriers to adoption of DTM? Craig, do you want to answer that one?
I can take a crack. So we have a great history of estimating poorly the elimination of paper. I think what's really going to change it is going to be generational. The millennials coming into our workforce, coming in as customers, just don't relate to paper very well. They relate to video and graphics and real-time information. So their style of customer as an interaction as a customer or as an employee is going to drive the change probably more markedly than anything we do on the technology side. There are a lot of things we can do, though, as enterprises to get our customers to stop using paper and move to digital. We can provide incentives to do that. We don't today very well. We have consent marketing for, let's say, substitution of a paper statement on a monthly basis, substituting digital for that, has really been very poor. We don't make it a fair value exchange with the customer. The best approaches we see are offering a discount, offering loyalty points, offering something tangible. So we can do a lot if we truly understand the real costs of being an analog and paper-based process within our companies, and start taking a look at that really in a frank and direct way, and start offering a more fair exchange with customers.
Great. Thank you for that, Craig. This concludes our presentation. We are at the end of our event, and as I said, we will be emailing out the slides and the recording tomorrow. I appreciate everyone making time to be here today, and Craig and Steve, thank you both for presenting.
Thank you, Allison.